So, so you both had a good week so far then?
Yeah, not bad. What about yourself?
Very good, very good. The weather's been a bit mixed, hasn't it?
Oh gosh, soaking, absolutely
Yeah,
soaking
I
in.
drove down
Yeah.
to Kent yesterday, and there was a moment when I had the sun visor down to avoid the sun, but the rain was beating so
Yeah,
hard, and we were
yeah,
all
yeah,
doing
yeah.
30
Dangerous.
miles an hour on the motorway, which was absolutely crazy.
Lovely.
It
One of
was
your
good.
lovely trips.
Yeah, it was. I was down on the Kent coast, which was very nice.
Very nice. Oh, it hasn't mattered the wet weather to me because I've been holed up.
You've
Although I
been
wasn't,
nice.
well, no, I was out for lunch with friends at the weekend and with the kids, and all the plans were cancelled, all the walk, all the play park. It was just sitting in a
Eat
pub
then
getting
home.
in a tempest. So, but you know, at least we're in a
There,
pub.
there's worse places to be. There's worse places to be. We'll just give it another couple of minutes for people
Yeah,
to join, and then we'll
yeah.
get cracking, which would be good. So I'm looking forward to tonight.
Yes, yes. The final stage is the final few weeks before the budget to start thinking about things and making plans that
Everybody seems to
inevitably
think there's
it'll
going to be some really big changes, but maybe
they always
we
do.
won't be. Maybe we'll be sitting here and think, well, what was all that about? That's happened
But
before,
that
you know.
happened last year, and that'll
I,
be a
I think
little
I
thing
think for
to
me
that.
the interesting thing is it's been surprisingly quiet. There's normally a couple of little leaks out in terms
Leaks.
of just kind of testing the waters in terms of what people's reaction is, but this one's fairly quiet, and I'm sure you'll go into that in a bit more detail as we run through it.
Yeah,
Anyway,
absolutely. Well, with that, like with last year, we'll know on the day, but there's certain things that have been speculated on. So
They
yeah,
need
we
to
can
raise some
through
money, don't
those.
they? So they've got
Yeah,
to do something.
they got to do something.
sure do. We
Do
have a
something.
big hole in the bucket that needs filling, don't we?
Indeed. Yeah.
Right, I think we've got a decent number of people already joined us. I think what we'll do is let me get the introductions done. You guys can then get cracking, and then I'll jump back in at the end for questions and answers. So,
Thank you.
welcome everybody who's joined us. This is one of our regular webinars that we do through Frank Taylor Associates. Tonight, delighted to be joined by Adam and Sue. Adam is the Managing Director of FJ Wealth, and Sue is a long-standing financial consultant who does everything from wills to financial planning to protection. She does the whole gambit. And tonight, they're going to be talking about tax, wealth, and estate planning essentials. And we are going to have a chat about the budget and what the kind of expectations are in terms of what's coming. How you can be smart about your wealth and have quality tax planning strategies, how to manage inheritance tax and plan ahead. And then Sue will most likely talk about the power of estate planning and how to protect your wealth for future generations, and why a will is absolutely critical. And the difference between a will and a properly written will is quite dramatic, but Sue will take us through that. So I'll hand over to Adam and Sue now. I'm just going to turn my video and sound off so that people can concentrate on you folks. But I'll come back at the end and we'll do a question and answers at the end. So if you have any questions as we go, please drop them in the questions and answer box and we'll pick those up at the end as we go. But for now, it's over to you guys.
Perfect. Thank you so much, Andy.
You're very
So what
welcome.
I'll do is I'll share my screen now and we can get back to, oh, we can go back to the correct slide would be good. Here we go. Oh, let's come out of there and try again. Here we go. Right. So if I start the slideshow, hi everyone, welcome. A lot of you here this evening will have been logged on to one of our previous webinars with myself and Sue, or just myself, or just Sue. We do quite a few for the FTA group with Andy and Chris. But for those of you who haven't heard from us before, or haven't worked with us, this is just a little intro into us as a company. So we're specialist financial advisors to medical professionals. We don't exclusively deal with medical professionals, we'll help anybody, but we do deal with a lot of dentists, doctors, pharmacists indeed, and we have a real specialty in advising business professionals and medical professionals. So a lot of you here this evening will have specific needs based on your vocation in terms of insurances, in terms of the NHS pension, wills, and other things like that. So we're specialists in that area, part of the Frank Taylor and Associates group, proudly, and working very closely alongside Andy, Chris, Liz and the team, David, everybody in that group to service clients' needs. We are crucially independent and whole of market. If you don't have to use us for advice, but if you if you do have a different advisor, they need to be independent and whole of market, because otherwise you'll be left with a menu that you are not deviated from. If markets aren't good or it doesn't become suitable, you're just left on the menu. So we think that's absolutely crucial to giving the right advice to everybody. The services which we offer are listed there below. So of course, the usual from myself: investments, investment management, pensions, retirement planning, NHS pension analysis and advice, tax planning advice, working closely with your accountant. We also have a whole team dealing with protection advice, both for personal protection and business protection. Sue's going to touch on that this evening. Sue is head of the protection team, along with a couple of other staff members. And we do a lot of protection advice for our clients, because being in the medical profession, there's a lot more insurances needed and wanted to protect you and your family and your business properly. And then we also cover wills and trusts and lasting powers of attorney. That is Sue, who gives that advice within the company. So we do all other bits and bobs in between. If you think there's anything you need from any sort of financial planning point of view, it's likely that we do give that advice, or know someone who does. So you can always come to us with any query, even if it's not listed there. So to start with in the webinar, I'd like to pass over to Sue to talk to you about wills and estate planning. So I'll shuffle to the side.
Thank you very much, Adam. I think he's given me this slot because I'm aware, and I think you probably have all joined with a view that we're going to come up with a crystal ball and tell you what's going to happen in the budget. But I wanted to just grab your attention for the first 15-20 minutes to talk about estate planning and some of the things that we think we can continue to do regardless of whatever the Chancellor decides to do in the budget in the next month. So the surprising thing for you all will be that at least 50% of you won't actually have a will. And I don't want to direct this at anybody in any negative way, because working with medical professionals is quite rewarding for me. I made a decision to do this the sum total of 47 years ago. I've actually been in the industry that long. So nothing's changed. You're all very busy individuals. And one of the things that you really lack the enthusiasm for doing at the end of your busy working week is going to see your solicitor and setting up a will. So starting in the financial advisory world, I used to say to my clients, do you have a will? When did you last review it? And some of them would say, well, 50% or more would say, I don't have a will. And I got to the stage where I was really just wasting my time sending them off to a legal firm to get them done. So I decided to bite the bullet and set up our own will specialist department, take all the exams on top of all my financial exams, and really deal with that in-house, because that way I could be sure that our clients will be looked after correctly. And when I write a will for you, I'll write it with a view of understanding the way that medical professionals think and work, are remunerated and earn their money. And also, the most important is how they build up their wealth during their lifetime by acquisition of maybe more practices, more businesses, more pharmacy shops, and their estate can grow and grow and grow. And the will needs to reflect not only their current situation, but their expanding situation, because you don't want to be writing your will every 5 minutes. So what does a good will do? Well, obviously, the most important thing is it ensures that your estate is distributed to your wishes. Now, most of you will say, I would like to leave it to my children. Some people wish to leave their children out of their will. That's happens, on a regular basis. But let's imagine that you're standard, I leave it to my wife, my husband, and then my children. But more importantly, what would happen if you and your wife or your husband and your children were all to be killed together in a car crash or an accident, or maybe, something like COVID would strike a family or something like that? So we have to make sure that it doesn't go off in a strange direction, because without a will, oddly enough, if your husband and your wife and your children aren't there to take your assets, it'll go to your parents. And I'm sure none of you really wanted to go back up the line, but instead to go to other members of your family, your friends, or to even charities. So that's the first thing, making sure that the right people get, whatever you want to leave them. If a child has upset you that greatly, we can write the child out of the will. If I don't do it correctly, then the child will have an ability to contest the estate and make a claim. If we do it correctly with the correct note taking and the reasons why on a recorded basis, then it's pretty likely that will stand up in a court of law. Obviously, the most important for a young family would be to choose a guardian to look after your children. No one will ever bring your children up the way that you will. Nobody will ever do the job that you could do in bringing up your children. But choosing the next best thing, and the most, again, important thing is to choose somebody who is the right age group. Most people say, oh, it'd be my mum or my dad or my, or my wife's mum or my husband's dad. But in actual fact, I'm sort of reaching that age where I don't think I could look after young children if they were left to me. And certainly teenagers would be a bit of a handful if I was in my 70s. So think about the age of the guardian, someone who brings the children up in the same moral code that you would, does things the way that you would, doesn't have to be the same person that you would leave in charge of your financial affairs. You need to appoint someone as an executor and a trustee. The guardian could be someone totally different. But obviously, if you've got a religion, it'd be someone that will follow that religion, bring the children up with the same code of conduct, if you like, that you would have happily have achieved with your family if you'd been here to do it. I know that that's a horrible thought, and some people even put off making a will because it upsets them too much. I've had people cry in the interviews. I don't want to think about that. What happens if you predecease your child, now? And what happens if your child predeceases you? Horrible. Don't want to think about it. But I have to think about everything because, believe me, in my working life, I've seen every situation from young deaths to tragic, children dying and all sorts of horrible things. So let's just make sure that all eventualities are covered. You might have stepchildren. So many families now are blended. Unfortunately, one out of every 2 marriages will end in divorce. So these people remarry, and apparently the second marriage has even less likelihood of success. I think it's more likely that you'll divorce if you've married twice. So it's all a bit like not very good news. Now, if you do divorce and you then remarry and you accumulate someone else's children, they're your stepchildren. You may have different thoughts about how you'd want to leave your assets to your own children and your stepchildren, etc. So we would go through that with both of you. If you've got an estate that's divided into 2 and it's either proportionate or disproportionate, you can leave your money in different directions. If you live with someone, the one thing that you do get protected by marriage still in this country is actually death, because you do have rights as a spouse. You could inherit from your husband or wife free of inheritance tax. Now, if you live with your partner, those benefits don't exist. So providing for your unmarried partner is really important. Whatever sex they might be. A civil partnership, by the way, is treated like a marriage. So if you're in a civil partnership with the same sex, that would stand in the eyes of the law for spousal protection in leaving money on death. But if you're not in any form of contractual arrangement, then you just live with them and they need to be provided for in your will. I want to talk a little bit about safeguarding your family home. I like to use the word financial predators here. And the financial predators, aside from HMRC, which, we can do something about in a different way to try and reduce your inheritance tax, a properly written will repel other financial predators, such as divorce. Now, I'm not talking about, well, I am talking about your divorce. For example, you might have built up a great deal of wealth in your family home. It's not unusual now for me to come across £1 million family home. Let's split that into 2, £500,000 each. One of you dies, the other one remarries. What I can do by carefully writing the will is ensure that the deceased share of the family home never goes off to a new husband or wife, or their children, in fact, but stays with your own blood line, your own blood relatives. It also protects against another financial predator, which is long-term care fees. If you're someone that's checked in and you're more my age than Adam's age, you're going to be more interested in those nibbling away at your savings rather than what I've just mentioned. But more importantly, if you need care when you get older, the deceased share cannot be used to provide care for the survivor, because the deceased share is ring-fenced for the bloodline and not used for the survivor for any other purpose than to help them while they're living. So no one can force you to sell the house. No one can take it off you. You can use the house, buy a bigger one, buy a smaller one, but it will protect those assets against these financial predators. And I always add this one: what if your children are going through a really nasty divorce when you die? So you die in your 70s or 80s, your children are in their 40s or 50s, they're going through a divorce, and their partner stands a chance of inheriting half of what you're going to leave to your son or daughter. Well, if you do it via a trust, and this property trust, for example, covers the residential home, then the divorcing spouse will get nothing of your child's inheritance. It can stay in the trust until an applicable time to take it out. Mitigating the risk of family disputes, fairly obvious. I mean, if you don't write a will, the amount of carnage that can occur is unbelievable. And I've been there with people guiding them through the probate system when wills haven't been made correctly or haven't been made at all. One of the things I want to just speak very briefly about, because this one could be affected by the budget. So let's talk about budget. One of the nice things at the moment is anything you own that is relievable, that is bona fide business assets. For example, intellectual property, equipment, business property used only and fundamentally, absolutely for the business, is classed as a business asset that is relievable from inheritance tax. Now, what tends to happen is you guys build up some assets over your life which are business related, and I might interview you in your 30s and 40s and you'll say, I could be rich if I was dead, but I'm worth nothing alive because everything's in my business or everything's in my property. Well, that's fine. Your business, if you left it to your spouse, would be free of inheritance tax, but most of us want our business to go on to our children. One of the ways that we can ring fence that asset is to put the asset, the business asset, into a business property trust. This has really exciting opportunities, because if you want to leave that business to your children, for them to choose whether they want to carry on your business, they themselves could leave the asset to their own family in the same trust. So it's an enduring trust that can work for the family business to be left to the bloodline only. It has all of the benefits I just highlighted that the property protection trust has against what I call financial predators, but one other asset, which is that at the moment it's business property relievable, so there's no IHT on the assets that go in to that trust, and it means that you'll be able to continue that benefit for your children. So if you'd written one of those and business property was still relievable, then you'd be fine. You'd be able to deal with it. Now, what I don't know with agricultural property or business property is what the Chancellor is going to do. So we will be happy to update you after November as to what's happened. But I'm sure that they won't just take the benefit away. If they do, they might nibble at it, or at a certain level take it, or maybe reduce it. But leave it with us and we'll give you an update when we know. But it's something that could bring in a bit of extra revenue for the government. So it is possible that this would be something that they would attempt to alter or perhaps reduce in benefit. So what if the spouse doesn't want to run the business? Well, that's fine. You know, we can sell the business, but once you turn the business into cash, then the cash becomes part of your surviving spouse's estate, and the estate becomes, if you like, bigger with the asset that you've now got in it, which is cash. Now that's where we hand over to Adam, because Adam has ideas of how to reduce your estate for inheritance tax purposes, or bite the bullet and work out how to pay those taxes. Because what people don't realise is when that tax is due on the wrapping up of an estate, it's due first. So before we allocate any money to your children, your grandchildren, whoever you've left the money to, we have to pay the Inland Revenue. So having the money somewhere in your estate that can pay that bill to the Inland Revenue is very important, and Adam will be able to advise you on how to get around that. I want to also talk to you, I know this is not going to be affected by the budget, so I'm going to talk to you about the very big importance of having a lasting power of attorney. Most of you know what a lasting power of attorney is, and you'll relate it to your elderly relative, your mother, your father, or someone in their 70s who is losing maybe a little bit of their faculties. Maybe their eyesight's failing, or they're feeling a little bit frail, or they're having treatment for something like heart problems or cancer, or worse still, they've got dementia, something like that. They're losing their capabilities of looking after their financial affairs. Now, there's two types of powers of attorney. I'm going to talk tonight mainly about the financial one, but there is also a health and welfare one. And there's a really big discount to do them both together. So if you think that you're interested in the health and welfare one, just pipe up if we speak to you, because that is very simple. Once we've gathered the information for one power of attorney, then we can roll that forward in a simple fashion to the other one. The health and welfare one deals with things like when to switch off your life support machine, what your thoughts would be if you ended up in care, what etc. etc. But tonight I want to talk about the financial one. Now, you might be thinking, well, I don't need one of them, I'm not old enough. Well, if you run a business, you definitely need one of these, and I'll tell you why. If you have a business, even if you are in business together as a man and a wife, you cannot make decisions for the other one. So if you were halfway through selling your business and the sale was uncompleted, and one of you had a car crash or went into a coma, had a heart attack, or became very unwell, then the whole business sale or the whole business purchase would just come to a grinding halt to wait until that person recovered or passed away, which we hope would never happen. Now, when you create a power of attorney, you give someone else, whether that be your spouse or your child or your grown-up children or whatever, the power to step in and act for you in your financial affairs, either temporarily or permanently. So temporarily would mean that if you were having cancer treatment, you were very frail, you just weren't in the way of being able to deal with your business affairs, someone else could step in and make those financial decisions to pay bills, to pay the staff, to sell a business, buy some equipment, do whatever needed to be done without having to worry you. And then when you were better, you could take back over control again. And the lasting power of attorney lasts for the whole of your life. So it'd be very important to think of the right people to manage your affairs properly. And if it's a business, it may be someone with a business acumen as opposed to someone who's related to you. If you're both in business together, man and wife, shareholders, directors of the same company, that's fine. You'd make each other the primary attorney. And then I would strongly recommend you chose a reserve, because let's face it, if you're a married couple, you're going to be in the car together and you're going to be traveling together. So the chances are something untoward may happen to you together. Also, you could use it temporarily if you were out the country. And it doesn't happen much with my clients because they're all there and working in their business. But if you had to go out the country, you have an accident or a medical condition I covered. So it's to avoid business disruption. Now, I can do a power of attorney that is business related only, or I could do one that will cover all of your financial affairs. Most accountants will let you claim for this advice through the company because it's a part of business planning. So check with your accountant first, but the fee for organising this is normally business deductible. I want to just touch very briefly on one subject, which I don't want to bore you because life cover is so uninteresting. But if you don't get this part of your planning right when you're arranging your wealth, I always used to, when I was a young financial advisor, I've always loved working in protection. Most of the people I worked with really didn't enjoy it because they were much more excited by the tax planning and the more interesting technical work that Adam tends to do for our company. But I still maintain if you don't get these things right, the loan protection, the key person cover in your business, protecting the shareholders, etc., then you won't have the wealth to be able to invest with Adam in the future. And should anything untoward happen, then there's some cover there to cover you through these difficult scenarios. Now, I don't want to go into what life cover, critical illness and income protection are. You all know what they are, but my team deal with all of those subjects and private medical, which comes on an annual reviewable basis, and we would very much welcome the chance to even just give you a quote. But more importantly, if I can just touch on the left-hand side of the slide, which covers business protection. And some of these covers are tax deductible and can be paid for through your company. So if you're paying for protection at the moment, privately and personally, please obtain a review from one of my specialists here, because you could find that rearranging it through your company was very cost effective. So executive income protection, you might have income protection that you pay for yourself. This is a relatively new product and is being honed all the time, and is something that can be very advantageous for a company. Now, the thing to remember, if you do it through the company, the benefit normally goes back to the company. So that's almost like the yardstick to measure it by. Does my company benefit from this cover, or do I personally benefit? And if it's something where the company's borrowing the money, or the company needs to benefit because the company loses you or a key person or a shareholder or whatever, then basically it can be paid for and would be cost effective to be paid for by the company. At this stage, I believe that my slides are over, and thank you for listening. If there's anything you want to ask me, I do believe there's an opportunity at the end. And at this stage, I'd like to hand over to Adam, who's going to try and work out what might be looked at in the budget. Adam, over to you.
Thank you so much, Sue. So before going into the budget updates from last year and maybe talking about what's going to happen soon, I often speak to new clients who come to me and ask for advice on pensions, tax planning, investments, clever ideas. What do you think about this? What do you think about that? That's what I do. But you need to get the foundations done first. And that's just what Sue spoke about: protecting your family, protecting your business with your will, with your protection. And I would always guide clients, if you haven't got an up-to-date will, if you haven't got your protection reviewed and covered, that is what you do first. As much as everyone might want, oh, don't worry about that, I'll do it later, I want to talk about pensions and getting tax relief and all this sort of thing. Yes, but it is most important to protect your business and family. So this is a list of some of the budget updates that we saw in October last year. Capital gains tax went up for general assets, not second properties. Watch out as to whether that changes this coming budget. That went up quite substantially. Capital gains tax also went up for business owners. A lot of you here this evening will be business owners, as am I, and the business asset disposal relief went up by 80% in the budget. That's been phased in from 10% before the budget, up to 14% in April this year, and then up to 18%. So tax on selling a business, where you get a bit of a saving, but it used to be a big saving, now it's only a little saving. So unfortunately, an example of saying that they will promote entrepreneurship and support small businesses, and then bringing in a tax that shows that that's not the case. It's the sort of tax that could change back in future. If you're not selling in the next sort of 5-10 years, there's a chance it could come back. Although we normally see if taxes go up, they tend not to come back to where they were, especially when we've got a big deficit. So it might just be the new norm, but that was a big one last time and created a bit of a sort of shake in the dental practice world of selling and getting on with things and planning and across the country. Pension allowances weren't affected last time. A lot of you here this evening will be typing questions either now or at the end. What about pension allowances? What about tax-free lump sums? What about tax relief? The same noise happened last year. Every single budget, it's the same questions. Are they going to do this? Are they going to do that? Especially if it's a Labour budget, but nothing was affected in terms of allowances. I'll talk about that in the next slide where we talk about this year, because everybody's saying, well, I'm sure they'll do this, I'm sure they'll do that. Nobody's sure of anything. And that was proof last year. I had 100 people come to me saying, "I want to do this, I want to do that," and really potentially putting themselves at detriment by making the wrong decision. And nothing changed last year in terms of pension annual allowances, pension lump sum allowances. It all stayed the same, which was great. Personal pensions were brought into the inheritance tax regime, or were noted to be lined up to come into inheritance tax regime from 2027. So lots of our clients have big personal pensions. They've had loads of tax relief saving in, and quite a few of our clients are wealthy enough that they think, well, I don't need that pot. I'll use my other money, my ISAs, my cash and other income they've got, and I'll leave that, as was the case, and it's still the case actually until April 2027, inheritance tax free to my family. So there's no need to take the money out. I've had all this tax relief and I'll leave it on inheritance tax free. Sounds great. And the Labour government were the evil ones when they announced that it was going to be taken away. But it was the Tories a year and a half before that removed the lifetime allowance and created this position. The Tories would have definitely done the same thing. They would never admit it, but there is no way that they would remove the lifetime allowance on pensions, removing the cap for how much you can have without a sort of tax consideration, and keep inheritance tax relief. That was never going to happen. So the Tories lined it up. Didn't announce anything before they left because they thought we were on the way out the door anyway. Labour coming in and announced this. So this one is definitely a combination of the two parties. We saw employer national insurance contributions increase. For some of our clients, it doesn't make a lot of difference. For some of our clients with very small businesses, they've actually had a saving because the sort of threshold for where you start paying it has gone up. For people with businesses with 10, 20, 30 employees, the cost increase is considerable. And it's actually added on more cost in, the shops and online, because businesses who have lots of employees see a big increase, and that's just passed on to the consumer. So again, that was announced last year. VAT on private school fees. Andy alluded to some leaks last year. This was something that was actually announced pre-budget, but then confirmed again in the budget. So a leak of sorts. It wasn't a surprise by the time we got to the budget. But VAT applicable on private school fees, which has affected a lot of our clients. And then another sort of main one was a crackdown on non-dom status. The ability to live in the UK, but not really live in the UK for tax purposes, has been cracked down on. Another one that I haven't mentioned here, but was alluded to by Sue, was actually inheritance tax changes. There weren't major changes on the face of it last year, but one change which was well publicised was farmers having an inheritance tax change. So basically, before there was business asset disposal, business asset relief, it's called. No inheritance tax up to a very high figure, 10 million. Yeah. And was the same for agriculture. And now the first £1 million is inheritance tax free, which for a lot of our clients covers most of the value of the business. And then it's a 50% reduction to normal inheritance tax after that. So there has been a change. It's not for most day-to-day people going to make a difference. And nearly everybody, of course, sells their business before they pass away, and then the money's in your estate for inheritance tax. But of course, farmers was a big one because they keep their farms and pass on to families. So that was always just going to tick over. So that was another change. And Sue's pointed out they could go again on it. I'm not sure. I think there's other things they can do on inheritance tax, not to double down on what they may have already announced last year, but you never know, and that's what we'll get to in the next slide. There's been a lot of speculation with this budget. There was last year, and as Andy and Sue have said, a lot of you here this evening will be here to hear an insider knowledge on what is going to happen. We do not know. Nobody knows, and I doubt that the Labour government know exactly yet either. They'll be tinkering with things right up to the last minute. Anything you've read in the paper, anything you've heard from a friend, it is conjecture. Now, it doesn't mean that it isn't going to happen, but we had last year, as I say, all the pension allowances were going to change. Guarantee they're going to do this, they're going to do that. Nothing changed. Oh, they're going to change capital gains tax rates to in line with income tax. Didn't happen. These are often clickbait from newspapers to get people to click. It's not to say that some of them don't have any merit or any consideration or aren't going to happen, but most of the things you've heard won't happen. So let's talk about some of the big ones that have been speculated on and our thoughts, but again caveated with we do not know. And sometimes it is wise to not listen to the noise and to carry on. Sometimes it is wise to do something just in case if it doesn't put you in an adverse position. So if you've got a personal situation where you've got a tax-free lump sum you want to take out and maybe reinvest or gift or something of that nature, or you want to add money to a pension before the budget, or you want to do some gifting, you've got money that you sold a business, or you've got an inheritance you want to gift to family, there might be things that aren't detrimental to do before the budget because you would have done them anyway. In terms of the speculation, just to touch on it with some comments, so the property taxes overhaul, we don't know what's going to happen, but the noise that's been heard over the last year and a half is a change of stamp duty to like a wealth property tax, sort of creating an extra tax on buying and or selling properties over $500,000. This, although when you read articles, it's as if it's been announced, it has not been, nothing's been announced. So it's something which is possible. But again, we won't know until the budget. And to be honest, I'm actually in the middle of moving house myself. So this would potentially affect me. And I'm hoping, like last year with business transactions, they get a bit of warning on it. And people who are mid-transaction might not have to pay the higher, what was capital gains last time. But it is what it is if they do bring it in. We don't know. But that's one of the speculations. Another one's capital gains tax. This was more speculated on last year. For a very long time, capital gains tax on second properties, because there's no capital gains tax selling your home. Remember, that might change, for example, but it's kind of a bit left field, that one, if it did. But there's always been capital gains tax on buying and selling second homes or other properties, holiday homes, whatever it is. And that rate of capital gains tax has always been higher than normal capital gains tax rates. Now, last year, the normal capital gains tax rates were brought in line at 18% basic rate taxpayers and 24% for higher rate. That was the same as the residential second property taxes were before. I think it's absolutely plausible because any government, Labour especially, but also Tory, hammer property investors. And this is something I'll mention later on, is be really careful in over leaning towards having property, because it should, if you've got a lot of money, make up potentially part of a diversified portfolio, but there's nothing tax efficient about owning property, and it might get worse in the budget. We just don't know, but that's a potential. And I think that one's got legs, and more so than what I'm going to talk about next, which is the pension allowances. So many clients saying, well, they're going to reduce the tax-free lump sum to £100,000 per person. They're going to cut the tax relief that you get on pension contributions. They could, but remember that this government, first and foremost, wants to protect in what they deem as hardworking families, people who don't earn enormous amounts effectively, or at the lower end of the earning spectrum, and that's their remit. But also this government especially, but any government, are petrified of public sector workers, NHS workers, teachers, judges, firefighters. All the public sector, especially Labour, want to protect. Now, if a rule was changed to change the tax relief that was available on pension contributions, or change the lump sum allowance, it would greatly affect public sector workers unless they gave a caveat that they had a special rule, which would be tremendously unfair on everyone else, but it is possible. So I personally think that it's unlikely there will be a change to the tax-free lump sum, and that pension tax reliefs will be changed on that basis alone, but they could. So if somebody is saying, well, I wanted to add 50 grand from my limited company to my personal pension anyway, you might do it before the budget, just to kind of think, right, just in case they change something, or you want to make a personal contribution from inheritance or money you've saved up. Clients who want to take tax-free lump sum out anyway to fund ISAs, to spend, to gift, there could be merit in looking. Remember, if you're starting from scratch and trying to do this before the budget, from now, you haven't got very long. You haven't probably got enough time unless you literally do it yourself, because it takes 3-4 weeks. But that said, it's important not to panic. We had lots of clients last year who came to us who said, "Oh, I've taken my lump sum, oh, they're definitely going to change it." And then nothing happened. And they were like, "Oh, what do I do with all this money?" It's come out of an environment where it's invested. They've missed out on a load of growth. They were thinking, "Oh, where do I invest it? I can only put 40,000 into ISAs. What do I do with the rest? Oh, well, that's going to be taxable." So there's people who made loads of the wrong decisions last year. And it's just careful to keep a cool head with this. It's really one that especially I'm, waiting on bated breath. But as I say, we spoke to a lot of specialist companies and providers and their thoughts. And because of the public sector conundrum and that being affected, we think it is potentially unlikely that the rumours are true. A rumour about ISAs, which I just don't think is going to happen, is some sort of cash ISA allowance cap. I don't see how that would benefit the government at all. They've never mentioned investment ISAs. The allowance for adding to either cash or investment ISAs is 20 grand a year. They could feasibly bring in a cap on the amount you can have in ISAs overall, tax-free. But again, there's not that many people with enormous amounts in ISAs that aren't using them. We have a few clients who have lots of money in ISAs, of course we do. But for the general public, it's not like pensions where everyone's saving into a pension pretty much. So I doubt that will change, but that's still the rumour still sniffing about. And inheritance tax and gifting rules. This is one where I think has enormous legs in being changed. So what they've done last year is attack to an extent some of the inheritance tax reliefs on businesses, on other investments as well. There was investments in that qualify for business asset relief, and they've been affected too. There's still inheritance tax relief, but it was half as good as it was before. People at the moment, with the pension rules already announced that there's going to be inheritance tax, are sort of offloading money, saying, "Oh, well, I'll sort of take my tax-free lump sum out, gift it to my family, I'll do this." And I'll talk later about the gifting rules. But this is one the government want to sort of think, well, we don't want people to be able to gift everything away, because that's still spending your money, and gifting it have always been and will always be the best methods for inheritance tax planning. It's just very difficult to get that exactly right and make sure that you've got the affordability and liquidity that you want. And by gifting, I also mean use of trusts. So I think this is one they could change, but I don't know. Again, we just don't know. They could change the 7-year rule on gifting to a 10-year rule or a 15-year rule. They could bring in a lifetime allowance for gifting, because at the minute, if you had £10 million in cash, you could just gift it all away. Nobody pays tax, and you just got to live for 7 years, and then there's no inheritance tax applicable. That's how it works at the minute. They could bring in a lifetime limit of 500,000 or 300,000 or whatever it is, saying you can do a bit, but if you want to gift anything massive in that way, then we're going to tax you. So there's all sorts of things they could bring in. And to be honest, the general public would probably think, well, anyone who can afford to gift 500,000 away, well, that's fine, they can afford it. That's how they'll possibly be thinking in that respect. But does it change anything for this planning for the next month? If you were planning to gift already, like some of our clients, or move an asset to trust, then you might want to look to do it before the budget, potentially. That's what we've done. I'm going to touch on pension planning, and they still make up the most, biggest part of the planning that we do. NHS pension, I've spoke to loads of you here tonight already about your NHS pension. It's not related to estate planning, but it's a massive, like Sue said, on the business side, business protection side. It's a huge, important part of your wealth planning, making sure you make best use of it, know what you're going to get a forecast, look into the McLeod remedy, when to commence it, should you enhance your tax-free lump sum. If you've got an NHS pension and you're over age 55, you definitely should be getting some sort of grip on what's coming up and how to use it and what you're going to do in future. If you're over age 60 and you haven't taken your pension, you need to speak to me immediately. So we can help with that. Personal pensions, I've actually mentioned at the bottom, because people, as soon as the inheritance tax came in or was announced to have come in on personal pensions, said, well, is it worth it? What's the point of saving into pensions anymore? You could not be further off the mark. They are still easily the best place to save your money because of all the tax relief you get at the start. We've got a couple of slides after to demonstrate that with figures. So if you have pensions already, you need to review them, make sure that the holdings, the performance, the risk level, the features are right for you. Not just, oh, they're growing. Everything's been growing the last 2 years. Everything's been growing, but should it have gone up by 25% rather than 15%? Markets have been really strong, which means people take their eyes off the ball, but it's even more important now to get things looked at. You need to look at when and how to access your benefits. We talked about lump sum, also considering income options. And then funding. You should be looking to fund if you have allowances. You'd need potentially an advisor if you have an NHS pension or have a sort of a more complex situation with the allowances that you want to use up, to work out what allowances you have. But you should be looking each year at the opportunities. The rule changes recently haven't changed the benefit of pension planning. So this is some examples of adding to a personal pension or any pension from personal contributions and the tax relief that you get. Now, we have to factor in now the fact there's no inheritance tax relief on pensions, and I doubt that would change in future. I think that will stay. That you basically add in and you or your family take the money out and pay income tax on it, which is kind of how pensions were designed originally. So this is an example looking at higher rate taxpayer at the top now, 40% tax relief versus 20% taxpayer in retirement, based on you adding 10 grand, the government add 2,500 on top, you get another 2,500 back from your self-assessment return. And no growth accounted for. There's growth figures in it. We'll ignore them for the purpose of now, but based on putting it in, taking it out later, there's a 42% uplift on your money. You don't get that anywhere else. Putting it in now, taking it out later, no growth accounted for. Obviously, that would be on top, 42% uplift. So this still demonstrates the benefit of saving to pensions and taking the money out later. You've got a basic to basic there, which is a lower benefit, but still a benefit. And then at the bottom, where most of our clients might say is, well, I might get 40% tax relief now, but I'm going to be a 40% taxpayer when I retire because I've got this big NHS pension. Well, in this same scenario, there's a 17 or 16.67% uplift on your money. And there's very little you can do, if anything, that guarantees that you're going to be in at least that position. Now, if you look at the tables that account for growth, you can see that they're inflated. That's because in this scenario, the 5 grand tax relief that you've had that would have ordinarily been sat with HMRC has been invested and growing, and all the growth is in your pocket. And then you pay some tax when you come out, but you've got a massively uplifted benefit because you've had growth on the money which would have already ordinarily been sat with the taxman. That's often ignored with this planning as well. So you can see as the money grows, these benefits inflate. And a lot of you here this evening will be limited company, and this is probably more common as our pension contribution planning than personal ones now. And this gives an example of the uplifts on this. I won't go through all this in great detail because I think we're pressed a little bit for time, but it shows a scenario of retaining profits in the company, which is the lowest possible tax you could pay on business profits. You know, paying out as dividends would be higher taxed, of course. It doesn't mean we suggest retaining them and doing nothing with them, but that's an example against adding to a pension. And if you're a 20% taxpayer in future, you've got a 38% uplift on your money in this scenario. And as a 40% taxpayer, just under 14. Again, with growth of the funds, this inflates. So this is really important to look at still, regardless of the pension rules, is look at allowances and making sure your pensions are as big as possible within the allowances. There's other investment options to grow your wealth. This isn't talking about inheritance tax planning. This is talking about growing your wealth, which is part of it. You can't just account for inheritance tax. You need to make sure you get the most out of your estate as well. Using ISA allowances, venture capital trusts are useful for clients who might not want to invest for a long term if they're in their 40s and they, you know, a pension is only accessible in 15 years or so. They might say, well, a venture capital trust gives me some tax relief. Or clients who've used their allowances. Investment bonds, general investment accounts, also useful investments for trust planning, usually set up when you've got a big inheritance to invest, or you sell your business most commonly. When you've got a big chunk, you can't put it all into pension and ISA or VCT, because VCT are a bit a higher risk. You put most of it into these other products, and they provide some flexibilities to estate plan. Keeping cash is always very important, always, but you know, especially when you're sort of planning your exit, when you're planning your growing family, you know, making sure you make use of those cash options are very advisable. And then I've got some tips down the bottom, which are growing tax efficiently. So not just investing, well, should you use an ISA or a pension or a bond, making sure the products are correct to make sure that most of that growth is in your pocket and it's managed properly. Spreading risk and diversifying, not having all your eggs in one basket is of course obvious, but we see a lot of people who come to us with, oh, I've got a pension worth 600,000, it's in 2 funds. That is just not the right thing to do. You need to spread it out across lots of different things. Looking at both partners, we often see lopsided arrangements, income and assets in one partner's name and their spouse has just paid little salary from the company. I would normally lead people to not equalize, but start saying, can we get more money or income over to them? Remember, everyone has an individual tax allowance, and all income tax allowances, capital gains tax allowances are individual. So really looking at both partners is crucial to put more in your pocket as a couple and as a family. And finally, at the bottom, be wary of excess property holdings. Don't get the wrong idea that I don't think you should own property. Lots of our clients have property as a really valuable part of their portfolio, but there's problems with tax on the way in, tax on the income, tax on the way out, liquidity, inheritance tax, hanging your hat like some people do on, I'll just have a business and I'll just buy a load of property. You're just going to come into problems later with estate planning and with liquidity. So again, can be part, of course, of a diversified portfolio, but you should do lots of different things as well as property and know what you're getting into. How are we doing for time?
I've gone part.
I've gone part. Well, gone part. I'm going to run over a little bit because these ideas are why a lot of you guys are here tonight. So how to inheritance tax plan and estate plan. Sue's given lots of useful information about things you need to do to protect your family and actually account for some estate planning and organization of your wealth. But, often people think, well, how do I save inheritance tax? Some of what Sue does will potentially save inheritance tax, but these are the things here to think about to plan ahead. If you have enough money that you don't think you'll need this chunk of money, then doing some of these ideas will save inheritance tax. I haven't written it down, but spending it is still the most effective. Now, that doesn't mean you sell a business and you blast everything within the first 10 years, but really enjoying your hard-earned wealth is part of inheritance tax planning. I have some clients who just, they've not touched their investments. They haven't bought that new car they've been talking about for 5 years. Just buy it, enjoy your money. And that, if you think in your head, everything you're buying, if you've got a very big estate, is going to cost 40% less of what you're actually paying, because if you kept the money and left it to the family, 40% goes to the government potentially. So if you think like that, it might free you up. First of all, you calculate your inheritance tax liability. There's some rules there. Up to £1 million is inheritance tax free on normal estates. There's some exemptions like business asset exemptions. You need an IFA to look at it for you. But remember, if you're a very wealthy client, very wealthy person or family, if your estate is worth over 2 million, and now soon this will include personal pension holdings, your allowance will reduce potentially down to only 650,000. So working out where you stand now and forecasting into the future is something we can help with. Using gifting rules is very important, and there is not going to be a golden gun method to plan your inheritance tax. People come to me and say, I've got all this money, what can I do as a one-off to sort it? Nothing. That is not going to work, because you can't hang your hat on gifting half your money away at once because of various rules and potentially tax considerations and affordability considerations. So little and often with spending, with gifting, is most of the time the best way. There will be instances of big gifts to trust or big gifts to the children, of course. It's not going to be just a few grand each year, but sort of taking care of it as you go makes a big difference over the long term, like with saving. So there's some allowances there: 3,000 a year annual allowance, £250 gifts and wedding allowances. They're important to make use of, but they're by the by. So the bigger ones that we work with clients on, regular gifting out of expendable income. Currently, if you earn, for example, 100 grand between you as a couple, and you can justify that you only spend 50 grand a year, then you are allowed technically to gift up to 50 grand a year as regular set gifts to certain individuals. And they should be classed as inheritance tax free. This is a big grey area, because you have to, how do you justify it's affordable without putting loads of records together? Well, you can, and we work with clients to put everything in writing to show their expenditure. It's a big pain. To be honest, I don't think you can hang your hat on this rule staying forever. This is the sort of thing that the government in the budget could just say, well, that's gone. You can't do that anymore. Because people are thinking, oh, I'll take extra money out my pension and then gift it away. Well, yes, technically that works at the moment, but this is the sort of rule that could change. So it is, something to keep your eye on with the latest budget, but could be really useful for some clients. And then gifts over the above are classed as potentially exempt transfers, they're called. What that means is there's no tax when you gift the money, so you can gift $500,000 in cash to your kids, for example. It starts a 7-year clock. Again, this 7-year clock is something that could change, or there could be a cap in terms of what you can do. So looking at these gifting rules as you go, and with certain moments where you think we really have enough, is useful. Whole of life insurance is something that used to be really, really popular until pensions became inheritance tax free in 2015. And everyone thought, well, I can get tax relief and just leave it all in the pension. But they're still very, very important and very, very popular with our clients, because it's a low risk or pretty much zero risk way of leaving money to the family, inheritance tax free, and reducing your estate, and also creating a cash pot to pay inheritance tax and avoid having to sell properties at lower rates quickly at the wrong time, or sell investments at the wrong time to pay an inheritance tax bill to release the estate. Effectively, you would pay a premium like any life insurance policy, but you would pay it until you die. These are often set up as joint life second death policies, so husband and wife. And on second death, when inheritance tax usually is payable, it pays to the family in trust, no inheritance tax on the payout. These are guaranteed to benefit the families if you pay them for the long period. You have to have in mind that these are effectively gifting plans. They don't benefit you. And anyone who thinks, oh, it's going to cost me a lot of money, isn't it? Well, yeah, that's the whole point. But it's going to cost you a lot of money, but the payout's going to be massive, and it's going to be inheritance tax free. So come to us for quotes on those and information if that was of interest, because that's something that you can start earlier in life without commitment for a massive chunk of money. And we've talked briefly about trusts here, about absolute trusts, discretionary trusts. Absolute are the simplest, money given to trust for an individual. Normally we set these up for grandchildren. Discretionary trusts are a bit more flexible. So as we're running over, I won't go into too much detail on these now, but you need to get advice. You can't just say, oh, I'll look at these and set them up. You need advice from me, or maybe from a solicitor. So something that we can help with, and other trusts available too. Andy will be glad to know that that was it. I knew I'd included too much for this evening, but obviously with the estate planning, I wanted to sort of touch on a few things in more detail. So thank you everyone for listening. Over to you, Andy, with any questions.
No, not at all. You always have a lot to rattle through. I think that's the problem. It's not that you just kind of drag points out. There's a lot of content to get through. We only have an hour. I've got a couple of questions of my own. Just give people a couple of seconds before if they've got any of their own. Sue, when you were talking about trusts, and you said an applicable age for children. Is there a rule of thumb about what an applicable age for a younger person to access a trust fund is? And I know people grow up at different ages and times, but is there a rule of thumb on when somebody should be able to access that trust?
Well, the legal age of accessing a trust is 18, but
yes,
I find as the years have gone on, most people are choosing a much older age than that. Now, that trust date can be set by the settler being the person making the will. And you can give an indication to your trustees that you would prefer that your beneficiaries do not access their shares directly until they reach the age of, say, 25 or 30. I have had people even go as high as 40. Wow. But what it does mean is the trustees have the ability to access money for the benefit of the beneficiaries earlier than that age for the reasons that I'm going to list: education, living allowances, worldwide travel, life-saving operations, and general allowances to be able to cover their expenditure.
Right.
What the trust does is protect the beneficiary from being a little bit under the influence of the wrong people, or perhaps taking substances or something that their parents wouldn't approve of, and blowing all the money on a fleet of Ferraris. So really the settler chooses the age.
Sure, cool. Yeah. And my second question for you, Adam, was you talked about CGT potentially coming in or going up on second homes. Any ideas on what that might move to and whether it's likely or not?
No, it's conjecture, like with everything else. I just think if you follow patterns of government, in terms of what has been happening in the property investor market in the last 15 years is that it's been getting worse and worse and worse and worse from a tax perspective. And it's been for a very long time where capital gains tax and other taxes like stamp duty on second properties or investment properties has been higher. And we're in this first time in a very long time where they're the same rate. So it could go up again. But no, there's absolutely no insight. It's just and it of course doesn't, unless you're about to think I'm going to buy an investment property in the next month or so, which very few people would just before a budget, unless you're trying to finish it off. That's something that's been, you know, going for a long time. So no, I wouldn't like to say that there's any ideas, because there's not. Anything into this evening is conjecture logically, but they could announce anything because they don't always follow logic.
No, they don't. They don't know. Governments are good at that, aren't they?
Yes.
And the last question is, you said don't put all your investments into property, but have it as part of your portfolio. Again, is there a rough guide as to how much you'd recommend that something
it depends on
in a pot?
not at all. It's
attitude to
you,
risk.
you can include it in your estate. Absolutely no set rule. It depends on your tax position. It depends on your liquidity position. If you think you don't want to have, you know, most of your money tied up, but then that said, you might have value-wise a £3 million home, which is actually, but then that's different because your home is very tax efficient. So I would never be able to put a guide, but you need to split with flexible investment, not just to diversify, but for liquidity and tax efficiency. So it's very difficult.
Just want to be aware of.
It's also
something to be aware of. If people are, as we see, just rolling, well, I'll buy another one, and then I get calls from people late 70s saying, I've got 20 properties, I've got inheritance tax problems, what can I do? I said, well, none of the options are going to be good. Are they not? Well, no, because you haven't diversified and you haven't planned ahead. So if you do have lots of properties, the important thing is to plan ahead. It may be advisable to sell some, keep some, give some to trust, to hedge your bets over the 20 years before you pass away. It's not like you're in a detrimental position, but it causes a conundrum. So that's something to bear with.
Also, Andy, we get asked a lot of questions about commercial property, which is very different to residential. And when people take the interest in commercial property, they're not normally looking for growth. They're normally looking for a yield, which is, are they looking for income? And that's a different attitude towards investing. And Adam will ascertain what their plans are and their desires are, their needs are, when he's giving investment advice, you know.
Yeah, but we can't advise on property. And, you know, I get people calling, well, I want to buy this property, what do you think? You know, every property is different. Every property is different. You can't just say it's this value and this is the rental. Well, what's the condition? What's, you know, so it's as I say, we've got lots of clients with property as part of their portfolio, and that's to diversify the right thing. We've got to have the appetite to run this property as well. You know, so it's something case by case.
Brilliant. Well, we've run over only by a couple of minutes.
Sorry, everyone. That was my fault.
We've nearly stopped there. So thank you very much indeed tonight. That was really good. Hopefully, it'll just give people a little bit of food for thought running up to the budget. And no doubt there'll be a debrief at some point once the budget takes place. But for now, thank you everyone who's joined us, and we'll see you for the next one. Thank you very much indeed.
Thank you, everyone.
Thanks everyone. Have a good evening. Thanks, Andy. Take care.
Bye.